Now, let me show you how smart money uses your impatience and impulsive trading decisions to trap you. This strategy is called the fake closure candle strategy, and it consists of 4 key candlestick formations. The first candle in this setup is the range candle. This candle sets the boundaries for the market during the day. The high of this candle marks resistance, the level where price struggles to go higher. The low of this candle marks support, the level where price struggles to go lower. These levels are critical because they define the range for the setup. Next, we have the inside candle, which forms completely within the range of the first candle. This candle shows consolidation or a pause in the market. It's a sign that the market is undecided and building energy for the next move. At this point, we know the market is in a range, but we're waiting for the next candles to give us more information. Here's where things get interesting. The third candle, called the fakey candle, plays a key role in this setup. During its formation, the fakey candle breaks out of the range. If it breaks below the range candle's low, it looks like a bearish breakout. If it breaks above the range candle's high, it looks like a bullish breakout. This is where many traders get trapped. They see the breakout happening mid-candle and jump into the trade thinking they're catching the move early. But here's the catch. When the candle closes, it ends up back inside the range. This is what we call a closure trap. The market gives the illusion of a breakout, but the candle's closure tells a completely different story. The fourth candle is all about confirmation. For a bullish setup, the next candle must close above the range candle's high. For a bearish setup, the next candle must close below the range candle's low. This confirmation is the final piece of the puzzle, telling us whether the market is ready to reverse or continue in the same direction. Without this step, the setup is incomplete. This strategy works so well because it takes advantage of the common mistake traders make, entering too soon during the formation of a candle. When traders see a breakout mid-candle, they rush to enter the market, expecting the move to continue. Now, let me share an important variation of this setup that can make it even more reliable. Multiple inside candles. Sometimes, instead of just one inside candle, you'll see several small candles forming within the range of the first candle. These additional inside candles indicate that the market is in a prolonged consolidation phase. Why does this matter? Prolonged consolidation builds energy in the market. The longer the market stays within the range, the stronger the eventual move is likely to be. This means that when the fakey candle forms, it's even more meaningful because it follows a period of indecision. Think of it like a spring being compressed. The more it's squeezed, the bigger the release when it finally breaks. In this case, the fake out and confirmation that follow are even more reliable because they're backed by stronger market pressure. So, if you spot multiple inside candles in a fake closure setup, it's a sign that the setup is gaining strength. Always wait for the confirmation candle to validate the direction, and you'll have a higher probability trade on your hands. Alright, let's walk through some real chart examples to see how the fake closure candle strategy works in live markets. Here, we're looking at the Solana daily chart. First, we have the range candle. This defines the market's high and low for the day. We mark the high as resistance and the low as support, creating the range. Next, we see the first inside candle, then a second, and finally a third inside candle. All 3 candles are completely within the range of the mother candle, indicating consolidation. Now, here's where things get interesting. This candle forms and breaks below the range during its formation. To many traders, this looks like a clear bearish breakout and they enter short trades immediately. But here's the twist. When the candle closes, it moves back inside the range. This is a closure trap, showing that the breakout was false. Does that mean we take action right away? No. We still need a confirmation candle. The next candle breaks above the range, confirming the closure trap. At this point, the market is likely to move higher for the next 2 to 3 days. The first condition of this strategy is identifying the trend. In trading, the market moves in 3 ways. An uptrend, where buyers are in control and push prices higher. A downtrend, where sellers take charge and drive prices lower. And a range-bound market, where price moves sideways in consolidation. For this strategy, our focus will be on the range-bound market, because that's where the magic happens. To break it down, when a trend moves horizontally, it eventually breaks out, either ascending or descending, forming an angular movement. This angle, typically around 45 degrees or more, is the hidden treasure we're after. For example, you might see a trend moving sideways before it suddenly drops, creating a sharp downward angle of 45 degrees. Or you may notice a horizontal trend that abruptly shifts upward, forming the same angle. These breakout angles are exactly what we're targeting. Now don't worry, this might sound complex, but I'm just explaining the logic behind it. We'll be using an indicator that identifies these angles automatically for us. Still, it's important to understand what's happening and why we're doing this. Let's see how this strategy works on a real chart, and I'll walk you through it step by step. First, look at this area. Can we say the trend is moving sideways or horizontal? Not at all. It's clearly going down, which means it's a downtrend, and we're not looking for trades here because this isn't the type of trend we need for this strategy. Now, check this section. The trend is moving sideways for a while and then it drops sharply, creating an angle of about 45 degrees. That's exactly what we're looking for. Let's find another example. Here, the trend moves sideways again, but this time it breaks upward, forming another 45-degree angle. Over here, we see the same thing, sideways movement followed by a sharp move upward at an angle of about 45 degrees. So here's the key. The first step is to find a sideways or horizontal trend. Then we wait for it to break out either up or down, forming an angle of around 45 degrees. This is where the opportunities are. But let me show you how to add it. Go to your indicators, type EMA in the search bar, and select Exponential Moving Average. In the settings, change the length to 20 and adjust the line thickness to make it easier to see. Now take a look. The 20 Exponential Moving Average shows us exactly what's happening. In this section, the exponential moving average moves flat and then drops at a 45-degree angle. Over here, it moves flat and then shoots up at the same angle. In this area, the price moves sideways before rising again, forming another 45-degree angle. Even with the exponential moving average, we can sometimes get false signals, but don't worry, we'll use another more accurate tool later to confirm. For now, let's move to the second part of this strategy, the inventory retracement bar. This might sound a bit advanced, but don't worry, I'll break it down so it's easy to understand. What exactly is an inventory retracement bar? In advanced trading terms, it's a candlestick bar that opens and closes at least 45% away from its high or low. In simpler terms, the wick of the candle should be equal to or greater than 45% of the candle's total size. Let's see it in action. Look at this area on the chart. The trend moves sideways before breaking downward, forming a 45-degree angle. That's our first condition. Now just below this angle, we need to look for our inventory retracement candles. Here's one. This red candle has a long lower wick, making up at least 45% of its total size. This is a strong signal for a short position. Here's another one, a green candle with a long lower wick. And over here, there's another opportunity, and another one as well. The inventory retracement candles are all over this area, giving us multiple chances to enter a short trade. Now, to make things even easier, let's use the Hoffman Inventory Retracement Bar indicator. Here's how to add it. Open the Indicators menu and search for Hoffman. Select the Inventory Retracement Bar created by Uday. Once applied, you'll see green and red triangles on your chart. These triangles mark the inventory retracement candles for you. Green triangles signal a potential short entry. Red triangles signal a potential long entry.